When you invest in a company, you're essentially handing over your money and trusting management to do something smart with it. So the biggest question you should be asking is, are they actually making money with my money? Today, we're doing a deep dive into the one metric that answers that question head-on, return on equity, or ROE. And we're not just going to look at it as some formula from a textbook. We're going to treat it like a powerful diagnostic tool, the kind that separates a surface-level glance from a real professional understanding of how a company truly performs.
All right, here's our game plan. First, we're going to nail down exactly what ROE is. Then we'll get practical and talk about how to actually use it in the real world. After that, we'll look at a more advanced use, forecasting a company's growth potential. And this next part is crucial. We're going to uncover the hidden dangers, where a high ROE can actually be a huge red flag. Finally, we'll pull out the ultimate consultant's tool, the DuPont framework, to see what's really driving that number.
So, let's start with the absolute basics. At its core, return on equity is all about answering that one fundamental question. It's a direct report card on how well a company's leadership is using the money that shareholders, people like you and me, have invested to actually generate profits. It's really the bottom line on capital efficiency.
So, the official definition is that it's a measure of financial performance. But think of it this way. For every single dollar of your money that the company has, how much profit did they generate this year? If a company has an ROE of 15%, it means they created 15 cents of profit for every $1 of shareholder equity. So you can see why a higher ROE is generally a sign of a more efficient, more profitable company.
And here's the formula. It's beautiful in its simplicity. Net income divided by shareholders' equity. Now, let's quickly break this down. Net income isn't just revenue. It's the pure profit left over after every single expense, interest, and tax has been paid. It's the true bottom line. And shareholders' equity, that's what's left over when you subtract all of a company's debts from its assets. You can think of it as the company's net worth. So ROE is really measuring profit against the net assets of the business.
Okay, so you calculate ROE and you get a number. Let's say it's 18%. So what? By itself, that number is totally meaningless. To make it useful, you have to have context. You need to benchmark it against other companies, against the market, and against the company's own past performance. Let's look at a quick example. Here we've got TechCo with an 18% ROE. Now, compared to the S&P 500 average, which hovers around 14%, that looks pretty decent. But the real test is against its direct competitors. The peer average here is 15%. So TechCo's 18% tells us that it's probably better than its rivals at turning shareholder money into profits. That's the first critical layer of analysis.
And this is a perfect example of why you can't compare apples to oranges. A big utility company, for example, needs a ton of expensive stuff. Power plants, power lines, they have huge assets and often a lot of debt. For them, a good ROE might be 10%, maybe even lower. But then you have a software company. They can generate a ton of income with just laptops and brainpower. For them, an ROE of 18% or even way higher could be completely normal. The key takeaway? Always benchmark within the same industry.
All right, now let's take this to the next level. ROE isn't just a report card on the past. It can actually be a powerful forward-looking tool. You can use it to get a pretty good estimate of how fast a company can grow without having to borrow more money or issue new stock.
And the way we do that is with something called the Sustainable Growth Rate, or SGR. The formula is pretty simple. You take the ROE and you multiply it by the company's retention ratio. Now, retention ratio is just a fancy way of saying what percentage of the profits does the company keep and reinvest in itself. It's the opposite of the payout ratio, which is how much they give back to shareholders as dividends. This SGR tells you the maximum speed a company can grow using only the cash it generates itself.
Now this is where it gets really interesting. Look at these two companies. On the surface, they look identical. Both have a 15% ROE. But Company A pays out a decent chunk of its profits as dividends, so only retains 70%. That gives it a sustainable growth rate of 10.5%. Company B, on the other hand, is plowing almost everything back into the business. It retains 90% of its earnings. That gives it a much higher SGR of 13.5%. So even with the same ROE, Company B is built for faster future growth.
So far, we've basically been saying that a high ROE is a good thing. But now we have to put on our skeptic's hat, because sometimes an incredibly high ROE isn't a sign of a great business. It's actually a massive warning sign of some serious hidden risks.
And if there's one thing you remember from this section, please let it be this. A high ROE can absolutely lie to you.
It can be artificially pumped up by things that have nothing to do with good management or a healthy business. And it's our job to figure out when that's happening.
So what are these red flags? Well, first, watch out for inconsistent profits. Imagine a company that's been losing money for years. Every loss shrinks its shareholder equity. Then, suddenly it has one good year. The profit might be okay, but the denominator in our formula, the equity, is now tiny. That makes the ROE look spectacularly high, but it's totally misleading. Second, excessive debt. This is a classic trick. Remember, equity is assets minus debt. So if a company borrows a ton of money, its equity shrinks, which automatically inflates the ROE number, even if profits are flat. And third, a company can use that debt to buy back its own stock. This shrinks the equity base even more, pushing the ROE higher while hiding some potentially deep-seated problems in the business.
So, how do we spot these lies? How do we get past the headline number and see what's really going on? Well, that brings us to the master key, the ultimate tool for this job, the DuPont analysis. If ROE is the final grade, DuPont is the breakdown that shows you exactly how the company got that grade. It lets us look inside the number.
This quote just says it all perfectly. The DuPont framework breaks ROE down into its core drivers, so we can see what's really behind the performance. Is it amazing profitability? Is it incredible efficiency? Or is it just a whole lot of risky debt?
So here's how it works. DuPont splits ROE into 3 levers a company can pull. The first is net profit margin. That's how much profit the company squeezes out of every dollar in sales. It's all about profitability. The second is asset turnover, which measures how efficiently the company uses its assets to generate sales. It's all about operational efficiency. And the third is the equity multiplier. This is just a measure of financial leverage, how much the company is using debt to juice its returns. You multiply these 3 things together, and you get ROE.
And this right here, this is the aha moment. This is why we do this. Check out these 2 companies. They both have a 20% ROE. Without DuPont, you might think they're similar, but look closer. Company A is a luxury brand. It gets there with a massive 20% profit margin. It doesn't sell a lot of things. Its asset turnover is really low, but every sale is incredibly profitable. Company B is a discount retailer. It has the exact opposite strategy. Its margins are razor thin, just 5%, but it achieves that same 20% ROE through insane efficiency, turning over its assets 4 times faster. They get to the exact same result, but through 2 completely different business models.
So let's wrap this up with the key takeaways. Number 1, ROE is your go-to metric for profitability. Number 2, a standalone ROE number is useless. You always have to compare it to its peers and its own history. Number 3, if you see a super high ROE, get skeptical. Dig in and check for things like high debt. And finally, use the DuPont framework. It's the key to deconstructing ROE and understanding the why behind the number. Is it margins, efficiency, or leverage?
So the next time you see a company's ROE, you won't just see a percentage. You'll know how to look inside it. You'll see a story about strategy, about efficiency, and about risk. The question is no longer just what is the ROE? It's what is this number really telling me about this business? And that changes everything.